Adrian, you've been silent, so I'm going to ask you some questions. Now, as an advisor to early stage companies who probably contemplate a variety of funding sources, what are you telling them in terms of whether they should consider an online or offline combination, and what sites to look for, what to think about?
Well, I think in this day and age, everyone has to consider an online approach to raising capital, even if they ultimately determine not to go forward with it. It would be a mistake not to consider it as an opportunity. And I think one of the things that's really interesting that hasn't come out so far is that in addition to the help you can get from your investors and from the platforms, one of the things that we saw is, well, this is the exact opposite of stealth. Right, and so what we found was that a lot of strategics will take a look at these sites looking for opportunities that have nothing to do with investing, and that these small companies will get access to major brand names, not on the investment side, but on the potential strategic relationship side. Some of our companies have had a great deal of success in really moving their business plans forward much faster than they ever could have, because it's unlikely that had they called directly any of these companies, they would have gotten anywhere. But because of the platform, because of the way that they were promoted, and because of interest in their product, demonstrated by the crowd, whether it be a product crowd or an investment crowd, they really took a step forwards quite quickly. And the other thing I tell them is that it's really different. Right, there is, and you all could probably talk about that. It's probably different on each of your platforms, but as people think about equity crowdfunding, and in particular going out truly to the crowd, the way that you market your security outside of all the legalese, which is of course critical and important, but the way that you actually market and explain your company is very different than the 20-slide pitch deck that people have been using for decades. Right, it's very glossy. There are people put together videos. People have to really explain what they're doing, even the most so in the life science space, where it is complicated to understand what a lot of these companies are doing. And if you don't do a good job of explaining to the investors what you're trying to accomplish, you will fail. And if you fail, you're going to have a hard time getting other money because you've already gone to the market and it's been very public.
Mm-hmm. Mm-hmm. What about selection of sites, things to watch out for? I mean, our panelists, I'm really happy, are obviously high integrity, really focus on, how do we make sure that the curation process is right. Honestly, I have seen panelists where CEOs of sites have gone up and said, mark my words, in the future, the best video wins. That just scared the heck out of me, Jilliene. I completely agree with you. But as an attorney to these companies, how do you help them think through what sites, what to look out for, what are the watch-outs?
So let me react to the video question first, which is I think that the idea that the SEC has certainly, and it sounds like some of the platforms have as well, is that communication by investors over the crowd, social communication is going to make it so that the best video doesn't win. Sure, it may get a lot of traction and attention, but ultimately the communication the investor is going to have should hopefully shed light on whether it's a good investment opportunity or not. As far as picking portals and platforms, I think what you've heard tonight from everyone here is that this is an outgrowth of existing relationships. It's not brand new. It's something that they've developed based on what they've been doing for many years and having great expertise. And I think that is fundamental, looking at portals that do come out of either the venture side or the financial services side, but really understand what it means to be a part of this environment is really important to success for these companies. Track record, those types of things are nice too, but there's going to be a lot of new sites, and it's going to be a lot based on who is behind the sites as they get started.
And what about how many investors end up on a cap table question?
Well, that's a great question. I think that the way that our panelists are presenting it, using the traditional Reg D approach allows them some control over that. But the crowdfunding example actually almost demands that if you want to raise any significant amount of capital, you're going to get a lot of investors, and you're not going to know them. You're not going to have any meaningful relationship with them, and you're certainly going to have to think about how do I actually manage this process of being a, for lack of a better term, semi-public company.
And moreover, what if you disappoint them?
Likely because you don't have relationships, likely because maybe they aren't in the category where they understand the risks and they really truly can't afford to lose it because they're making 10 of these investments and one of them will pay off. it may lead to a higher likelihood of litigation. On the other hand, the dollar amounts being invested are lower, which may make litigation not quite as valuable. So, that remains to be seen. But certainly, one would expect that there's going to be a higher level of maintenance and shareholder interaction than might otherwise typically be the case, where people are used to a process where they invest and they wait, and they know it's going to take, in the case of life science, 5 years, 8 years, 10 years.
Okay, so I wanted to turn this over to the audience. Do you guys have any burning questions you absolutely?
The advantage of being close to the moderator. But sort of following on with what Adrian is saying, so the issue of numbers of investors, I know some of the sites put together what I'll call an LLC, right? So they may take a carrier, they do something like that. But are you guys all having individual investors, or are you creating funds and so that there's an investor, LLC 8 or whatever it is that might be?
We create a single entity for each of our investments. So the real estate companies have a single investor, which is fewer than what they would have without us.
At CircleUp, we have individual investors, so you will have the investors that invest through the platform individually on your cap table. The companies set the number of investors that they'd like to have in the round by setting the minimum check size, so companies get to determine what that ultimate outcome is. We haven't seen a deal where there's more than 40 investors, and we've had deals where there's 4 investors, so it varies by company and by that check size that they choose to set it at.
And it's typically 25K or?
It varies widely. We've had companies that have set it at 25,000. We've had companies that have set it at 10, 15,000. It varies widely by company. We've had companies that have set it higher.
We create single-purpose rifle shot funds, limited partnerships. So it's one cap table entity. It's a venture fund designed for one investment.
I have a question about. Thank you. I have a question about investor access. Jilliene, you mentioned that the investor called you and said, I know some prospective tenants for this property. And it created a question in my mind, why didn't they call the managers of the property? And this is a question that can go to all 3 of you. If you have an investor that does want to get involved, do they go through the platform or do they go directly to the company?
Our investors typically go through the platform. They trust us. So back to that issue of trust, they have a relationship with us. They trust us. There's someone in the company who they've interfaced with historically. So I'd say more often than not, they come directly through us, but there's also occasions where they want to discuss directly with the real estate company, and we're not opposed to that. We're completely open to that, depending on, what the investor is interested in, what they're looking to do. We've taken investors on drives of properties that we're looking at. I just had an investor fly into Los Angeles to have me drive properties with him. So it totally depends on the investor. I'm a big believer in customer service. So give the investor what they want, and not every investor wants the same thing.
We typically see the investors reaching out to the companies directly. A lot of times the companies will reach out to us if they're looking for a particular introduction or something to that effect. But the investors, after the raise, are typically reaching out to the companies. We have some post-investment tools that companies can use to communicate with investors through the platform. So similar to the forum that companies use while they're raising, we have that offered in a private setting between companies and investors. And actually a lot of companies will reach out to investors through that and say, I'm looking for XYZ, can investors help me to do that? So, but the relationship is very much between the company and the investor, and we prefer it that way. These are people that are backing the companies, and we want them to get involved and if they can be helpful, to do so. And we like that direct set of communication between the two.
Adrian, do me a favor. Take a look at these and let me know which one we should ask. And I'm going to ask one. Let's see. Many angels are worried about crowdfunding will cause a lot of undeserving companies to obtain funding. especially not your sites, but there are many, many sites out there, thereby muddying the water for better ones. It would certainly up the ante in how much capital everyone has to raise to make themselves stand out. Not like what is happening right now in the crowdfunding space, actually. So, Andrew, I'd like to start with you. As a VC,
Yep.
right, this is really a question that goes to the heart of traditional versus new form of capital raising and what happens in that new world with so much capital coming from all different sources and maybe less discerning than traditional what has been raised.
Sure. So, I think Jillien's made the point, you all made the point about marketing folks, getting involved in the business. I worry a lot about that. I think that your incentives matter, your model matters. I think the folks who are jumping into the space and who want to, who are often broker-dealers, and no offense to you guys are doing a great job. And I think, by the way, CircleUp, connecting individuals with companies is a very smart way of trying to mitigate some of that risk. But if your incentive is to just do lots of deals, lots of volume, that's what you're going to do generally. If your incentive is to find the very best deals, you'll probably try to solve for that. I think there are a lot of folks who are going to enter the space, not so much in healthcare now, but it's going to happen, right? There's a few sites we know that are doing this, which I guess I won't name right here. But I worry about it. I think that there are going to be bad actors. I think that when you kind of step back a bit and look at the whole crowdfunding industry, I look at Kickstarter and Indiegogo, and these guys are moving hundreds of millions of dollars with very little fraud. Even though we can debate kind of what fraud is, because some of the things that people buy on these sites, little tricky. By the way, it's not SEC regulated, unbelievable. But there's very little fraud because if you have multiple folks around a deal, light begins to shine on the information around those deals. And I love the fact that more information is coming out all the time. These deals are becoming more and more transparent. That's the way the world is. That's where the world is going. I think there'll be growing pains, if I had to guess. And all we can do, all of us can do, is do the best we can by our investors and by the companies, and hope that SEC doesn't freak out too badly when some things go sideways. And SEC is being very measured and very thoughtful, and not really enabling things right now. But I get it, because there's a big downside in where they're going. So we're being very old school, Reg D, 506B right now. I don't know if that answers the question.
You can respond.
Yeah, so I think it also depends on the sector, and considering that is important. So in consumer, these companies don't have an alternative when they are earlier than 10, 15 million in revenue. And so they don't have a VC fund to go to. And so even the best brands will struggle to raise capital efficiently. They'll still spend, 6 months, 12 months, 18 months, and they won't be able to get in front of the right types of investors that can add value beyond that. And so at least within consumer, we are seeing, the best brands go through our platform or through this type of alternative fundraising and going to individual angels because they don't have a VC firm to go to. So I think it's certainly a benefit for investors to not have that kind of leftovers from the institutions. So we've found that consumer lends itself well to this type of fundraising.
Yeah, so I would say the social mobile, the SaaS, and all those kinds of typical IT deals where they're getting a lot more traditional funding today, Adrian, right? So the question is for those folks and for the people who fund them, what are the implications? Any comments?
Well, I think it's becoming easier. It depends largely, I think, on how much you need over the life cycle of the business. I think for a lot of companies where the sweet spot is $2 to $3 million, which there are an awful lot of those companies in the valley, you can probably expect to see a shift away from institutional and really developing these types of programs, specific to an industry or a niche. That may very well supplant a lot of the existing institutional, even individual super angels who now will have to go to these platforms in order to make their investments. For companies that require substantially more capital, for real estate investment, for life science companies, it may very well be a great way to seed, but you're going to need the institutional money. You need the expertise, you need the experience, and there is a lot of value added in knowing how to build a company, knowing how to coach a management team through a process that a lot of these investors have been through repeatedly.
So you're teeing up this next question that came through live streaming. Once crowdfunded, how difficult is it to raise the next series of funding? Andrew.
We're having no problem at all. We're getting the deals that are pretty well-capitalized deals of, hitting a milestone, things going well. My answer really is, if you get into a deal that goes sideways, it's tough. You get in a deal that is a rocket deal, that is going to the moon, and everyone wants to pile in, everybody wants to pile in. Once we're in a deal, there's no concern. I think the question really has been convincing other VCs that this model is a good fit for them. But once we're in, there's never an issue. For us, so,
But
and it's
actually,
6. So.
in your sector, right, in particular,
Yeah,
typically the cash needs are very high.
right.
And so, the more the better, so to speak. That said, in the IT world, and I don't know if you can really relate to that, but there have been many examples where people become, they're in pig heaven with so much capital, they waste a lot of it, and they don't necessarily have the good outcomes. Have you heard or observed any of that kind of behavior? Do you worry about it?
You mean overcapitalizing companies?
Yeah.
Happens all the time in healthcare, and not a great thing. I'd say that since healthcare is challenged right now, it's generally harder to raise capital now than it's been for the last 20 years. That's a little less of an issue. I'd rather have a company that has the capital around the table, investors that have deep pockets. Our latest deal, Google led the deal, great co-investor, deep pockets. So I think that in healthcare, it's an unusual time right now. But overcapitalizing any business is not a great idea, and equity capital is expensive. So I don't like seeing it. I think it drives perverse behaviors.
Katie and Jilliene, anything to add?
So we actually have a lot of private equity firms that send us deals. So I think that speaks to their excitement about what we're doing. They aren't ready to fund these companies. They're too small for them. But they like the brand and they want to see that company grow to come back to them. And the most efficient way is to get that capital, grow the business, and then the companies are a better fit for those firms. So we've been really happy to see that those firms are really supportive of what we're doing. Also the strategics. So our partnerships with Procter & Gamble, General Mills, they find a lot of interest in what we're doing as well. So we don't see any issue in terms of raising future capital. We have some companies that are now raising capital and having their next round and haven't heard any struggles there. I think these are companies that were doing this anyways. So they were raising money from friends and family and individuals, and they were just doing it less efficiently. So it's a natural process that these companies go through, and we're just helping them to get that capital faster.
So Jilliene, the real estate is driven by projects, so not the same deal at all, right?
Yeah, ours is a little bit different because if a real estate transaction needs more capital, you're probably in a bad place. That being said, we require all of our projects to overfund. So we require capital reserves in place for every single project that we do in the event that something happens. It's my conservative nature, I suppose, coming out of the corporate banking world, and we don't want to be in a transaction where an investor has to put up additional capital. So we negotiate against capital calls for all of our investors. It's part of our process. We've got 2 in-house legal licensed California attorneys in our company who do a lot of this work for us. So we force them to raise more capital. And in addition, sort of the other side of that is real estate companies using us more than once. So we're seeing real estate companies come back to us, fund additional projects with us because they've had a really good experience. Investors have had a really good experience with them, and investors want to be in more transactions with this specific company. And then, Kathy, I thought I'm insanely scared. So I will just go on the record here and now. I'm insanely scared. There's a Series A crunch, which is only going to get worse because more and more startups are going to get funded through crowdfunding in this Series seed stage. I'm also insanely scared by other entrepreneurs who are running crowdfunding companies, and I'll share a prime example. There's 2 real estate transactions going on right now in the live market that are deals that we saw 2 months ago and passed on. There are deals that didn't meet our underwriting criteria 2 months ago. They went to their friends and family, couldn't raise the capital, and they're now using crowdfunding sites. True story. And that scares me and keeps me up at night and makes me really worried about investors. And this always goes back to culture for me. culture and trust and knowing the people that you're doing business with, knowing the entrepreneurs who are running these crowdfunding platforms. It's really challenging in the early days because they don't have a track record, right? I mean, our platform's been in business 7 months. Albeit we've distributed $500,000 back to investors, we still don't have a very deep track record. I'm not going to say that we do, because we don't. But I think that there are other indicators that you can look at for crowdfunding companies and the types of businesses that they're doing business with, and the way that they answer questions, right? Do they answer emails properly? Do they answer questions properly? If you're ever being sold by a crowdfunding company, run, right? Like, absolutely run, because there should be no selling needed in crowdfunding. They should be bringing you really good transactions that you want to invest in that you can get comfortable with without the word, sale.
That's really great comment. I wrote down widows and orphans when Adrian talked about the SEC concerns and the reason why we had legislation to begin with, and how Jobs Act was really opposed by the SEC, and they dragged their feet for a year and a half before they actually came to the table. Required a new SEC chief, I think, to do that. And so as we close this thing, let me ask you guys to think forward a bit. Andrew, you talked about growing pains, and I think Jilliene, you're basically talking about the same thing. I think, let's just go out and say, a lot of widows and orphans are going to actually lose money. I suspect that there's going to be knee-jerk reaction by the Congress to have sort of other reversals of rules and regulations and legislation that get passed. There's going to be a huge amount of confusion in the market. So let's talk about you three pristine sites. As you struggle through and try to make good on this new horizon and new vision, right? And having to deal with the bad actors potentially, and the losses and reversals and liabilities and all this stuff. What do you think about what keeps you up at night? How do you make good?
And I'm concerned about it, but again, what can you do? You have to do the right thing by your investors, and one thing that I think we do keep track of is the SEC. We don't want to jump in their face and get on the radar, but we're close to them. We know people who are close to them. And I think we're just kind of trying to hang around the hoop a bit and try to be helpful with some comments, but, do the right thing.
I think I get less sleep than anybody on the panel worrying, is my conclusion from the two of you.
Well, you three companies and you three people restore my faith. I came into this whole thing with a lot of questions and a lot of doubt. As an angel investor, I certainly feel my traditional way of doing business and investing threatened. But at the same time, I'm very curious about what's happening. That's another reason why I'm doing this. But I'm really pleased to see that there are, in fact, a lot of sites out there, you three included, who are trying to do the right thing and do it with integrity. So I congratulate you, and I wish you all the best. Thank you so much for being here.
Why do you think that your way of funding is going to be...
Okay, hold on a second. Sorry, you want to take the mic and ask?
No, you'll hear me. Why do you think that your method of angel investing is being threatened by this?
The question is, and I'm going to repeat it for the live stream, why do I feel that my way of investing is going to be threatened? Actually, I think that of all of the different sources of funding, organized angels, which is what I do, is probably one of the most potentially threatened area. And the reason is because we, unlike the super angels, we don't necessarily have personal reputation and the huge successes or the large, deep pocketbooks to build syndicates online and lead them on places like Angel's List. And we worry about the liability, so we don't necessarily want people to follow us or offer advice. So there are a lot of different places, and then on top of that, a lot of deals can basically afford to go to the crowdfunding sites as well as come to the angel groups. We actually put at least work on diligence, and we put the companies through a ringer, and yet we have to syndicate deals to make $1 million happen for companies, which means that they have to present to multiple organizations and go through multiple diligence processes. And so for those kinds of companies that could raise money online, it is in fact a more efficient process. And so the organized angels really have to think hard about what is our domain, what is our value proposition, how do we invest, how do we work with the VCs on one hand, the super angels on the other hand, and the crowdfunding sites on the other hand.
Good answer.
Okay, we have one more.
The deals you all have been doing are high quality deals with accredited investors, but in the fullness of time, don't you think that platforms will develop that are dealing with unaccredited investors and questionable morality?
I think the answer is yes. Besides, right now we're doing it. Besides New York and healthcare, that's targeting Title III. They don't seem to know what they're doing. So, by the way, I think you do lose the most sleep, but I lose some sleep. I lose some sleep because obviously bad actors. You said it, bad actors are going to come out. They're going to do bad things. People are going to lose money. The question is, what can we do about it? All we can do is build trust, do the right thing, but it's going to happen. You guys?
I agree. You know, and I worry as much about the bad actors as I do about the people who are operating under good intentions but don't actually know what they're doing.
Right. Right.
That's maybe scarier.
Well, and I think the thing to remember is that there are bad actors now, right? There are lots of people who lose a lot of money through the Bernie Madoffs of the world and similar, much smaller types of transactions. And so what the crowd potentially brings is the ability for the community to look and say, we believe, the internet has a dark side. We have, the email scams that we've been dealing with for 10 years. Will there be some securities that are sold in that way? Probably. And I think that it's sites like these that are going to help investors learn how to determine between the types of investments they can look at in a virtual world and feel comfortable with, and the types of investments that they should shy away from, just like we've learned to delete our spam. And that'll be a learning process. And it'll be even more of a learning process when it's opened up to the entire crowd and not just the accredited investors. And there will be websites that they'll develop their reputation for being a trustworthy place to invest in these types of companies. And that will be ultimately long-term what succeeds. But there'll always be fraud. There's fraud today. There was 100 years ago. It's the reason the 33 Act and all these restrictions went into place in the first place. It's a pendulum that's swinging, and we're still trying to figure it out, and I think the market will figure it.
So your question actually on the other hand, Chance Barnett, crowdfunder, is not here, but he founded that company expecting to basically crowdfund in the legal sense from unaccredited investors serving community-based SMBs. So imagine the companies that are the corner restaurants, the baby shop, the babysitters, the children's gym in the neighborhood, right? Those companies have no place to go when it comes to funding today. And the crowdfunding, as defined by the SEC and Congress, is actually a fabulous platform for that kind of funding sources. And so, a little bit of money from a lot of people who really want something, some service in the neighborhood. I think that is, just like Craigslist, eventually develop the zip code-based, localized, regionalized resale marketplace. I think crowdfunding has a place for the localized, neighborhood-based SMB investor. Well, thank you so much for our panel.